Why hello there, folks. Welcome back to the channel for another exciting video. If this is your first time stopping by, consider hitting that subscribe button, and while you're at it, give that like button a good old smash. I'd truly appreciate it. And don't forget to ring that post notification bell, so you're in the loop every time I drop a new video. Now, before we dive in, I've got a little heads up for you. Be cautious down in the comments section, as it can sometimes be a bit spammy and swarming with scammers. Just to clarify, I'll never ask you to contact me via WhatsApp or Telegram, and I absolutely do not manage investments for my subscribers. So please, stay on guard and don't fall for any scams out there. Now, let's dive into some exciting news, the October jobs report. Just recently, we got the scoop on how the job market has been performing, and to my surprise, it's a win. The market expected an addition of 180,000 new jobs in October, but it turns out that the economy only added 15,000. Now, you might be wondering, how is that good news? Well, it's all about perspective. In September, the economy added a whopping 300,000 new jobs, and this created some concerns for the Federal Reserve, or the Fed, as we like to call them. You see, when the job market is red hot, it can lead to inflation, and that's not what the Fed wants. They're like the traffic cops of the economy, and they're trying to manage things to keep inflation in check. One factor that might have impacted the job numbers for October is the United Auto Workers strike. Upwards of 45,000 to 50,000 workers are currently on strike, and that could have had an impact on the job numbers for the month. We'll have to wait and see how November pans out to get a clearer picture of the job market. Nonetheless, a win is a win, and it's a step in the right direction. Now, why is the job market so crucial? Well, as Fed Chair Jerome Powell mentioned on November 1st, it's one of their main concerns. When Americans have job security and wages are on the rise, they tend to spend more, even when interest rates are high. That's because they're confident in their financial situation. In a tight labor market with low unemployment, people are optimistic about their finances, and they continue spending. But when things start to get shaky, folks tend to tighten their belts, fearing job loss and struggling to find new employment. That's why a healthy job market is essential to keep the economic engine humming smoothly. The Fed has been keeping a watchful eye on this, and they've highlighted the impact of strong job markets on spending. During the third quarter of 2023, GDP hit 5%, indicating that people were still spending. And that's a bit of a red flag for the Fed because they're trying to cool things down a bit to keep inflation in check. So, this October jobs report is a step in the right direction. Now, the next key data we're eagerly awaiting is the CPI, Consumer Price Index, inflation report for October, which is set to drop next week. This report is another piece of the puzzle that the Fed uses to determine their monetary policy. If inflation is still coming down, it might give the Fed a reason to hit the pause button on interest rate hikes in their December 13th meeting. But if the CPI report paints a gloomy picture, there's a chance the Fed might raise interest rates again. Though it's widely expected that they're done hiking rates, it's more of a wait-and-see situation. They'll monitor the data closely and adjust their policies accordingly. So, what does all of this mean for us as investors? Well, it presents an opportunity to build wealth. Here's how it works: when interest rates are high, the stock market tends to be a bit subdued. It might have occasional bounces, but it won't see consistent upward trends. However, when the Fed starts reducing interest rates consistently, the stock market starts going up. High interest rates often cause the stock market to go down because borrowing is more expensive. Lower interest rates, on the other hand, encourage more investment, which is good for the stock market. So, now is a prime time to take advantage of this opportunity. We can invest in our favorite companies and ETFs at a discount. And then, we hold on to these investments until the next bull market arrives. That might be in 2 years, 3 years, or more, but patience is key. The formula for building wealth is simple: buy blue-chip assets when they're on sale and hold on to them until they're trading at a premium. You buy low, sell high, and that's how you create wealth over time. It's important to understand that this is not a get-rich-quick scheme, it's a long-term strategy. The key is to commit to dollar-cost averaging, which means investing a certain amount of money into your portfolio every month. By doing this, you give yourself a chance to grow your net worth over time. The ultimate goal here is to achieve financial freedom, and this strategy can help you get there. In conclusion, I want you to keep in mind that thoughts become things. If you can visualize your financial goals, you can turn them into reality. Believe in yourself and keep chasing your greatness. Building wealth takes time and patience, but with the right strategy, you can achieve financial freedom. And that's a wrap for today's video, my friends. As always, please remember to leave your thoughts and comments down below. I'd love to hear your perspective on these financial matters. Let's keep the discussion going and share our insights. Together, we can all learn and grow. Thank you for tuning in, and I'll catch you in the next video. Peace.